This is the brief on JD.com's technical setup and options strategy, especially with its Q3 earnings just around the corner. Okay, so we're looking at JD, the big Chinese e-commerce player. Right now, its chart looks kind of weak ahead of the November 13th earnings, and we're focusing on how you might handle that really high implied volatility it's got going on. First off, the technicals? Yeah, they're flashing some warning signs. JD's trading near 31.79, and that's below both its 50 and 200-day moving averages. Not great. Now, the valuation looks cheap. PE ratio is just 8.98. But here's the kicker. The implied volatility, or IV, is way up there at 45.5. That basically means the market's expecting a big swing, almost 7% or about $2.20 when those earnings drop. Second, that earnings report on November 13th, it's a huge potential gamble, what we call binary risk. It could go really well or really badly. Just look at the analysts. Some see it hitting $40, others are way down to $28. The big uncertainty seems to be management's own warning about Q4 growth slowing down sharply to maybe 5.6%, way off their usual 14+% average. Finally, what's the play here? Well, the recommended approach is patience. Wait it out. Specifically, hold off on setting up those defined risk option spreads until after the earnings dust settles, like on November 14th. Why wait? Because that sky-high IV, it's expected to absolutely crater, drop by 30, maybe even 50% after the news is out. That IV crush makes entering spreads like a put credit spread or an iron condor much cheaper. So, JD looks cheap, but definitely risky. The smarter move seems to be using that post-eroding volatility drop to get into defined risk spreads once you see which way the stock actually breaks. This technical analysis is for ticker JD and is purely educational and not financial advice. So don't blame Kaka when earnings create unexpected portfolio surprises. Paper trade strategies mentioned in this episode to get more understandings.